Hi friends, today we are going to discuss about futures contract, its meaning, features, advantages and disadvantages. What are futures? Futures is a standardized agreement between buyer and seller to buy or sell a particular asset at the predetermined future date for an agreed price. Under futures contract, future date is called delivery date or final settlement date, and the agreed price is called a futures price. Under futures contract, underlying asset may be a commodity, security, or currency. And we know futures are exchange traded instruments. These are traded on recognized exchanges like NCDEX, MCX, NSE, BSE, etc. Under futures contract, the buyer and seller never trade directly between them. Here, the trade happens to a clearing house which acts as a guarantor of performance to both of the parties. Futures contract represent an improvement over the forward contract in terms of standardization, performance guarantee, and liquidity. Hence, it is rightly said that a futures contract is nothing but a standardized forward contract. It is a legally enforceable, exchange traded, standardized contract. Now, let's see a simple example for futures. There is a farmer who cultivates wheat. At present, the price of wheat in the market is rupees 50 per kg. But after 1 month, that is after the harvest, he feels that the price of wheat may go down. Here the farmer wants to earn at least rupees 50 per kg. While the other person, Mr. X, is at the expectation that the price per kg of wheat may go up. So the farmer and Mr. X enter into a future contract. Here, farmer is the seller who is at short position and Mr. X is a buyer who is at long position. And here we can see three scenarios. They are, if price increase from rupees 50, it is a profit to Mr. X, the buyer. And if the price remains at rupees 50, there is no profit or no loss to Mr. X, who is a buyer. And the price decrease from rupees 50, it is a loss to Mr. X. These are the three scenarios arises at the expiration date of futures contract. This is a simple example, and now let's move to the features of the futures contract. First feature is it is not a bilateral agreement. Futures contract is not a bilateral agreement. As said in the meaning, it is an agreement between buyer and seller, but they are not traded directly between these two parties. The trading always happens to a clearing house which acts as a guarantor to both of the parties. And the second feature with respect to futures contract is they are traded in recognized exchanges. Futures are exchange traded instruments. These are traded on recognized exchanges like NCDEX, that is the National Commodity and Derivatives Exchanges Limited, or through Multi Commodity Exchanges of India Limited, National Stock Exchange, or through Bombay Stock Exchange, etc. And the next point is standardization. In futures contract, everything is standardized. That is, you should specify what quantity of asset you will be buying or selling, at what quality you will be accepting, and the location of settlement, and on what date and which month you are going to perform the contract, and the units of price. Here, since a futures contract involves a third party called the clearing house, it is a clearing house who decides the day for settlement, and you cannot have the performance beyond or before that particular day. So, what are standardized? The quantity of asset, location of settlement, the date and the month to perform the contract, and the units of price. And the next feature here is the clearing house. The trading is going to happen to a clearing house, and this clearing house does all the back office operations. So we don't have any risk of default because it gives you the performance guarantee. That is, it is going to guarantee both the buyer as well as the seller on the performance. If either of them makes a default, then the clearing house would take the responsibility and ensure the performance of the contract. And the next point is margin system. Here the clearinghouse is actually acting as a guarantor, so it takes up um, the risk, especially the default risk is undertaken by the clearinghouse, and in order to protect itself from the risk, the, they require the seller and buyer to maintain a particular amount as a deposit with them. That we call it as a margin, and this margin money may change with the changes in daily price. If the price is going up, then buyer's margin is actually getting reduced and seller's margin increase. When the price comes down, the buyer's margin increases and seller's margin get reduced by the equal amount. And this is a margin system. And we can see the marking to market is another feature of futures contract. It is a practice of periodically adjusting the margin account by adding or subtracting funds based on the changes in market value to reflect the investor's gain or loss. This leads to changes in amounts daily. It leads to changes in amounts daily, hence the profit or loss are settled daily. This ensures that there are no defaults by either of the parties. And the next feature is elimination of risk. In case of futures, default risk or counterparty risk is eliminated. Counterparty risk means the possibility of loss resulting from a counterparty's failure to meet its financial obligation. So here in futures, the default risk is eliminated. This is so because transactions are done through clearinghouse and not between the buyer and seller directly. And the last feature here is a long position and short position. The trader who promises to buy is said to be in long position, and the one who promises to sell is said to be in short position. These are some of the characteristics of futures contract. Now let's see what are the advantages of futures contract. First one is it opens the market to investors. Futures trading can appear to be a quite attractive investment option because of its features, mainly the elimination of counterparty risk. Futures are mostly useful for the risk tolerant investors. Their standardized features and very high levels of leverage make them particularly useful for the risk tolerant investors. And the next advantage is a stable margin requirements. Margin requirements are for most of the commodities and currencies are well established or well known in case of futures market because they have been relatively unchanged for years. Margin requirements may be temporarily raised when an asset is particularly volatile, but in most of the cases they are unchanged from year to 1 year to the next. Thus, a trader knows in advance how much margin he should put up in a contract. And the next advantage is it offers high liquidity. Another feature, another major advantage of future is the high liquidity. Most of the futures offers high liquidity, especially in case of commonly traded commodities, currencies, and indexes. This allows the trader to enter and exit their positions when required. And the fourth advantage is no time decay or time decline. Time decay means the value of asset declines over time. The main reason for time decay is expiration of time. In case of options, we know that there is time decline or time decay which reduces the profitability for trader. But a futures trader does not have to worry about the time decay. And the next point is hedging against a future risk, or there is no counterparty risk in futures. Many people enter into the futures for better risk management. The companies often use these contracts to limit the risk that may arise mainly from foreign currency exchanges. And we know there is no counterparty risk in futures to the futures traders. And there is protection against high price fluctuations. This can be used as a hedging tool in industries with a high price fluctuations. And lastly, the pricing is easy to understand in futures contract. Futures pricing is easy to understand. It follows the cost of carry pricing model. Under cost of carry pricing model, the futures price should be the same as the current spot price plus cost of carrying the underlying asset until the maturity of futures contract. So these are the advantages to the futures contract. And finally, we can discuss the disadvantages to the futures contract. The first one is margins are required. In futures, it is the clearing house who undertakes the default risk. To protect itself from the risk, the clearing house requires both buyer and seller to keep margin money with them. This ensures that both the parties will perform their contract obligation. This is viewed as a drawback because both the parties needs to keep a particular amount as margin money. And the next disadvantage is perfect hedging is not possible. Perfect hedging refers to that position which completely eliminates the risk because in futures contract we can say the perfect hedging is not possible because of its standardized features. Most of the futures contract may perfectly eliminate the price risk only and not the quantity risk. Quantity risk means uncertainty about the quantity that will be sold or purchased at the future date. So it can be said that it offers only a partial hedge. And the next drawback arises here is the timing issues. Futures contract come with definite expiration dates. That is, the expiration dates are fixed in the contract even if you have established fixed prices for the assets in the contract. Those prices may become much less attractive to traders as the expiration date approaches. So this is meant by timing issues. And the fourth disadvantage or the fourth drawback here is the leverage issues. Futures typically use high leverage. The leverage offered by the futures contract is both an advantage and a disadvantage. The advantage is that the trader does not need to put up 100% of the contract value while entering into a trade. Instead, he can enter the contract for only 5% or 10% of the contract value. And the disadvantage involved here is because of the fast movement of future prices. The price can go up and down daily or even within minutes. This is meant by leverage issues. It can be advantage but also a disadvantage for the traders. And the last point is least flexible. As we already said, everything is standardized in the futures contract. So it is least flexible. And that's all. So here we covered futures, its meaning, a simple example, its features, advantages and disadvantages. I think you all are clear with this topic. Thank you.